We're here today to launch our July bi-monthly report, focusing on trends in all sectors of the Irish commercial property market in the first 6 months of 2014. I think it's fair to say in all sectors of the market we've seen extraordinary volumes of transactional activity during the first 6 months of the year. And there's nothing to suggest that that pace will slow down as we enter the second half of the year, with a large number of assets and portfolios due to be launched for sale over the coming weeks and months. In the investment sector, there's obviously been quite a lot of activity, with lots of players such as the private equity investors very active over the last number of years. As the Irish market continues to recover, we would expect to see some of these private equity players beginning to retrench their activities in the Irish market, look for opportunities in other jurisdictions. Thankfully, we are beginning to see a new wave of entrants coming in to replace those private equity investors, more longer-term institutional players who obviously have lower growth expectations. We've continued to see the pace of yield compression in the Irish market easing over the last number of months. In fact, prime office, retail and industrial yields have remained quite stable over the last 2 to 3 month period, which is very encouraging. We expect to see continued sales activity in the investment sector as we go into the autumn selling period, with a large number of portfolios, mixed use and specialist portfolios, due to be launched for sale during the late summer, early autumn. We've continued to see strong volumes of foreign direct investment into the Irish market, and that in turn is manifesting itself in very strong volumes of take-up in the Dublin office sector, particularly in the Dublin 2-4 central business district. Prime rents have continued to increase. In fact, in addition to the 25% uplift experienced during 2013, we've seen prime Dublin office rents in 2 and 4 increasing by a further 15% to approximately €40 per square foot in the first 6 months of this year. This level of growth is much higher than anticipated. Indeed, we had anticipated that prime rents would reach that level by year-end 2014, as opposed to the mid-year point. Until such time as new supply comes on stream, which is at least 2 years away, we are going to continue to see very strong increases in prime rents due to the imbalance between supply and demand. We're now beginning to see some occupiers looking at the merits of locating in suburban schemes on the basis that the city centre is getting quite expensive. We've continued to see strong activity in the retail sector over recent months. Much of this activity is focused on Dublin and other major population centres, and particularly focused on prime shopping centres and retail parks. And in fact, we've seen quite a lot of appetite from investors for the various retail park and shopping centre portfolios that have been offered to the market over the last number of months. We've continued to see strong activity in the industrial sector, albeit this has not been translated into strong take-up volumes as yet, because many of these deals are taking some time to sign. So we would expect to see a much stronger second half in that sector this year, with many of the large transactions agreed recently unlikely to actually sign until at least Q3. We've seen the first uplift in industrial rents in 6 years during the second quarter of 2014. Prime industrial rents in Dublin are now approximately €62 per square metre, or €5.75 per square foot. We've also experienced quite a lot of activity in the hotel and licence sector of the market over the last number of months. In fact, in the first 6 months of this year, 27 hotels around the country have traded, totalling between them over 130 million of transactions. This is more than twice the volume of activity experienced in the Irish market in the same 6-month period in 2013. This is a volume that's going to increase significantly in the latter half of this year as more portfolio sales come to the market. Equally, there's been a lot of activity in the licence sector of the market, and quite a lot of appetite around the Capital Bars portfolio, which is currently on the market in Dublin. In the development land sector, we've also experienced strong volumes of activity, and again, this is a sector where transaction volumes in the first 6 months of the year are higher than the entire volume of activity in 2013, with 54 development sites totalling over 200 million completing in the 6-month period. This again is a sector where there is expected to be an increase in activity in the second half of the year, as large sites such as Cherrywood and other portfolios of land are expected to be brought to the market. This is much needed because much of the double-digit house price inflation we're experiencing in Dublin at the minute is simply due to a lack of large plots of land being released for sale. We would expect to see strong activity in this sector in the second half of the year. All in all, in the Irish commercial property market, as you've seen, there has been a very, very strong volume of activity in the first 6 months of the year. We're not experiencing the traditional summer lull that would normally be the case in the property market. If anything, transactional activity is going to pick up pace considerably over the course of the next number of months. So a very, very strong 2014 is in prospect. It is likely over the next number of months that the actual investors and occupier types will change. Many of the private equity players who have been very dominant in the market over the last number of years will start to retrench their positions and focus on other locations, where a lot of new entrants are likely to come into the market, and these are likely to be institutional in nature. A very busy autumn and winter is in prospect in this sector.